Hey, how's it going, everybody? Welcome to another IFVI video series. In this series, I wanted to talk about stock market investing. Start off with some basics and then eventually work our way through a lot of different videos into some more complicated topics and analysis techniques. This video is going to talk about just a very brief introduction on what the stock market actually is. Just to let you know, through this video series, we're going to be focused on particular IFVI investments and just to kind of give IFVI members a focus on what our portfolio actually consists of. But these videos are good for anybody who wants to learn more about the stock market and stock market investing. So let's just go ahead and dive right in. So what even is a stock, right? People use the term, I own stock in this or I own stock in that. Whatever company that they currently own shares of. And essentially owning stock in a company means that you've purchased shares that were issued by a company. So, let's say I own 20% of the shares that were issued through a company. That doesn't mean that I'm entitled to 20% of that company's assets. So I can't just walk in through the doors of, company X and say, hey, I own 20% of this company. Like, I want that desk over there. Like, that's just not the way that works. Essentially, through owning 20% of the shares issued by that company means I'm entitled to 20% of the profits generated by that company. And so that's what I'm actually entitled to as a shareholder. So what else are shares good for then, right? What's the whole point? Is through owning stock in a company, by holding on to those shares, I get a right to vote. So if there's a shareholder meeting, I get to attend, and I have whatever percentage right to vote on whatever decisions are being discussed. I can also receive dividends if the company issues dividends. We'll get more into that later, of course. I have the right to sell those shares. So if I bought in at $2 price per share and the share price goes up to $5, I can sell all the shares, some of the shares, whatever I want to do for whatever that profit is. And of course, if there's a takeover, merger, or if a company files for bankruptcy, then I'm entitled to whatever portion of that transaction. However, I might not be top on the pecking order of who gets paid first. In a merger versus bankruptcy, it's a very different transaction occurring there. So yeah, there's different ways to be reimbursed for holding those shares, for purchasing those shares. So those shares are actually traded on exchanges like the New York Stock Exchange. A lot of people have heard of that. Each country has their own different exchanges. So in the United States versus a country in Europe, companies will be traded on very different exchanges. So short-term stocks normally fluctuate. Their price normally fluctuates based on public opinion or whatever news comes out for that company. Long-term, the company's true value will normally be shown in their price per share. So if you research a company that have really good fundamentals and you really believe in them long-term, then you can buy and then wait for a few years. And if you want to sell, 5-10 years down the road and you think that, that's really where it's going to capitalize on, then so be it. If you're going for more of a short-term trade, then you're going to be paying attention to the news and public opinion and forums and stuff like that. So, all right, so why even buy stocks? What's the whole point? Essentially, you're purchasing a very small portion of a company, right? And what that means is that company's working for you 24/7, generate profits that you benefit from. So you guys have, inline agendas with like, hey, I'm trying to make money, you guys are trying to make money. And that's the way it kind of works, right? It's a mutual benefit. So we as investors profit through dividends being distributed to its shareholders, or of course by selling those shares for a profit, whatever you pay for them. So that's kind of the investment and gamble that we take. Companies just keep trudging along, and they use shares and they go public in order to raise capital. So that's why companies even go public to begin with. So a stock market exchange, right? Like I said, they operate geographically. So within the United States, we have like the NASDAQ and the New York Stock Exchange. Those are two very popular ones, and you can think of them like a grocery store, right? So you have a supplier or someone who's trying to sell shares, right? They come to the exchange, and then us as the buyer will go to that exchange and purchase what we're looking for. So that's kind of like a metaphor for you guys. This is like a grocery store, I guess. So normally there'll be an asking price, and then of course there'll be a bidding price. So as soon as those prices overlap, the seller gets rid of their shares, and the buyer now owns those shares and everything that comes with it. So a stock market is all of the exchanges in a geographical region. So the U.S. stock market has multiple exchanges. The Canadian stock market, and any country in Europe, and the Korean stock market, like all these different countries have multiple exchanges, or one or multiple exchanges, and all of those exchanges make up the stock market. So the stock market is not, one big global thing. Each country has their own. And so a company may or may not be listed on a United States exchange, but they may be listed on a Canadian exchange. So when you're looking at certain companies, you need to research, are they publicly traded? Are they actually traded on an exchange that I have access to? If not, can I get access to that exchange or whatnot? So those are questions you'll have to look into when you think that you want to invest in a certain company. All right, and so the last thing we'll talk about are indexes. So the most popular one is the S&P 500 or the Standard & Poor's 500. Essentially, it is a selection of 500 companies that represent the entire stock market. So they choose 500 companies that kind of best make up the stock market, and that performance of that index is normally considered, market performance. So if someone says, "Oh, did you beat the market?" or "Oh, I beat the market by 3%," basically, if the S&P 500 gave a 7% return last year and you got 10%, then you beat the market by 3%, quote unquote. So indexes are kind of just used as like baselines on market performance or whatever specific sector or theme that index has. So, the Russell 2000 was small caps. So if you're trading primarily in small caps, then you might compare your portfolio performance with that index's performance. Or you might buy an ETF or mutual fund that tracks a certain index. A lot of people use them for different reasons, but whatever your reason is, they're really good for whatever theme you're thinking about investing in. So that's basically what an index is. So we went over exchanges. Those are the grocery stores where people buy and sell. The stock market is the collection of all the exchanges. Indexes are basically just listings of like different themes. So indexes aren't traded, but there are funds that trade based on those indexes. And then of course, an actual stock or company, they issue shares that individuals buy and then sell or hold and receive dividends and stuff like that. So that's how the whole stock market kind of works. A company, goes through an IPO, initial public offering, which we'll explain later on. Then the shares are bought and sold, supply and demand. All of that happens through the exchanges that are tracked by the stock market and that are sometimes expressed on indexes. And us as investors or stock traders look at all of these things, analyze a lot of indicators and terminology that we'll go over later on, and then we just choose the companies that we think will make us money. And that's how the stock market works. If you guys have any questions, definitely feel free to ask. But this is just a very brief explanation of the stock market. So